Hey guys, welcome to DevTech Finance, and in this video we would be covering the topic Basel Norms. This video is a part of credit management module, so please don't forget to watch all the videos that has been posted on this module to understand credit management in a better way. So let's start with Basel Norms, starting with the introduction part. Basel norms were introduced by Basel Committee to have a standardized prudential norms for capital adequacy. So basically, Basel is a city which is located in Switzerland, and it is the headquarter or Bureau of International Settlement. So the Bank for International Settlement or Bureau of International Settlement was established in Basel city of Switzerland with a common goal to provide financial stability and common standards for banking regulation. So this is how these norms were given the name of Basel, and the committee who was forming the rules and regulations under this was called as Basel Committee, and the main focus was to provide capital adequacy, financial stability, and to standardize all the banking regulation. The prudential norms defined components of capital, assigned risk weight to different types of asset, and stipulated the minimum capital adequacy to aggregate risk weighted asset. So the what happened is that in this prudential norms, it was the components of capital were categorized. So we will see it further that capital was categorized into tier 1 capital and tier 2 capital. So and different risk weights were assigned to types of asset. So when we are providing loans, so what kind of loan is that and how much risk is related with that? So for example, when the banks are providing loan to sensitive sectors like brokerage firms or stock market houses who are dealing with market fluctuations a lot, so there the risk weightage would be a lot more as compared to other loans. And same goes with when we talk about secured loan or non-secured loan. So when secured loan, it would be having lesser of risk weight as compared to non-secured loan because there is no collateral or guarantee as such. So this is how we can assign different risk weight on the probability of default related in that particular asset. And this was mentioned under the prudential norms presented by these Basel Committee. And this is how what the objective was to stipulate the minimum capital adequacy. So if there is so much of risk involved in a particular asset, how much of capital should a bank keep with it in order to deal with that risk, in order to deal with the default situation? What should be the capital, adequate capital which should be kept there by the bank so that to minimize the risk related. So this is why Basel norms were introduced. The minimum standard of capital to be kept with commercial banks was fixed 8% of risk-weighted asset under Basel I and Basel II norms, which was increased to 9% of risk-weighted asset under Basel III. Okay, so we would be looking at Basel I, Basel II, and Basel III. So over the period of time, the Basel norms were revised and the more additions were made. So firstly, it was introduced as Basel I, where it was fixed that minimum standard of capital that should be kept by commercial banks would be 8% of the risk-weighted assets. And in Basel II norms also it was same 8% only, but in Basel III it was increased to 9%, looking at the increasing risk in the banking scenario and whole economic situation. So we will look after all these three Basel norms: Basel I, Basel II, and Basel III, which were standardized and evolved over the time. So let's have a look at the objectives of forming these Basel norms. So as we have discussed, the first objective was of risk management. So how much amount the bank should keep as capital in order to deal with those kind of risk, and how much risk should it allocate to different kind of assets, so whom we are calling as risk weighted assets. So what proportion of risk should be assigned to different class of assets, as such loans are in different sectors, so the risk related would be different in various sectors. Then liquidity. So capital adequacy norms also provide that banks should have liquidity in their operations, in their business. So capital, keeping capital aside in form of tier 1 and tier 2 capital as compared to the risk weighted asset also ensured that liquidity is maintained in the bank. And as such, we saw adequate capital, which we are talking about, was all about Basel norms, the objectives of Basel norms. Coming to capital adequacy ratio, so we are using this term very frequently when we are talking about Basel norms. So it's important to understand what capital adequacy ratio means. Capital adequacy ratio is the ratio of the bank's capital to its risk weighted asset. So as I already mentioned that to different asset classes, we assign different risk depending on the scenario in which that asset class belong. And for that, related to the risk, how much capital should be kept. So that is defined under capital adequacy ratio, the ratio of bank's capital to its risk weighted asset. The capital adequacy of banks is assessed based on following three aspects: composition of capital, composition of risk weighted asset, and assigning risk weights. Already we have discussed about this, and we understood what is capital adequacy ratio. And since it was the main objective of introducing Basel norms, it's very important to know about it. Now coming to CAR calculation. So how is capital adequacy ratio calculated? So the formula is tier 1 capital plus tier 2 capital divided by risk weighted assets. And what all things can come in tier 1 capital? So it would be shareholders equity, disclosed reserve, preferential capital and retained earning. While in tier 2 capital it would be debt, undisclosed reserve, loss reserve and revaluation reserve. So adding both these capital components and dividing it by risk weighted assets, the risk which we have assigned to different asset classes, we can calculate capital adequacy ratio. Coming to Basel I. So what all things was under Basel I? It came into effect in the year 1988. It focused majorly on credit risk. So when Basel I was introduced, the major risk that was in focus was credit risk, the risk of default. So whenever the banks or financial institutions provide loans, there is also, always a risk associated that whether that loan would be repaid in full amount or not. So the EMIs which are set, will that be timely paid, or the borrower may default, or will the borrower default on that. So this was credit risk, because the interest that banks charge from the borrowers forms the main source of income for bank, which they utilize for various business activities of banking, as well as providing further loans, providing further advances. So if that is interrupted, the whole banking business comes to a stagnant position, and that's why the credit risk plays an important role. So how to reduce these defaults, how to minimize the impact of these defaults. So this was the main focus when Basel I was introduced. Now the minimum capital requirement was set 8% to be achieved by the end of 1992, and it applied to all G10 countries. So the minimum capital requirement, according to this Basel I norm, was kept at 8%. So 8% of risk-weighted assets should be maintained by the banks and financial institutions in order to deal with the risk related, in order to have adequacy of capital in the business, so that the impact is not much, and to reduce the impact and business is not affected. So firstly it was applied to only G10 countries, but later on several non G10 countries also adopted the same, because other countries were also dealing with the same problem. They were facing the default risk, and it was increasing day by day, so defaults were happening. And what we see as NPA management today is all because of the defaults happening, and that is in crores. So banks, the major problem of banks is that they are not able to deal with this. So this is why Basel norms came into picture. But what all steps could be taken to reduce these risk, or to deal if that risk has occurred, how to deal with it. So other countries also adopted the same, to be to strengthen the soundness and stability of banking system, and to have high degree of consistency across the banks. Let's move on to Basel II. So this is a revised framework of Basel I, addition of some more components and to make it more stabilized in terms of regulations and norms. So this came into effect in the year 2006. Sorry, it focused on all sort of credit risk, market risk, and operational risk. So till now, what we saw in Basel I, it was only related to credit risk. So if the borrower defaults, what would happen? But Basel II dealt with not only credit risk but market risk and operational risk as well. So it recognized that not just credit risk plays a role when it comes to banking business. There are other risks as well. Which are termed as market risk or operational risk. So there could be risk related to the business operation of banking. There could be some errors. There could be the work is not being done properly, the process is not efficient, so that all could lead to operational risk. And there is always an involvement of market risk. So what is the interest rate going, what is the fluctuation in the market, how is the economic situation, is there a recession or something. So these all risks were also taken into consideration, because if we have provided a loan to any particular industry and that industry is going through a very bad phase, so the borrowers won't be able to make the repayment because that would be beyond their capability because of the economic scenario. So Basel II said that we need not focus only on credit risk. There should be other risks taken into consideration like market risk and operational risk. So altogether, considering all these three risks, the capital requirement should be set. And here the minimum capital requirement remains same at 8%, but it was on the basis of all three risk components taken into picture: credit risk, market risk, as well as operational risk. So when we are assigning the risk weight to different asset, all these three risks were related. Now, this provided for better risk management practices and advised bank on using internal system for assessment of risk. So, as operational risk came into picture, the internal system for assessment of risk became important, because banking operation, we have to still look at that also, whether the operations is going well, whether the process which is being followed to provide loans, is that an efficient process, is that ensuring that borrowers won't default, are we doing proper credit investigation, credit checking before providing loans. So these all things were covered in Basel II. The supervisors were advised to take suitable approaches for efficiency of bank, and the supervisors were given role to look at the efficiency of bank and to advise on taking suitable approaches under these Basel II norms. So three pillars were introduced in Basel II, and this was like minimum capital requirement. So this is same which was there in Basel I also at 8% of risk-weighted asset. Then another thing that came into picture in Basel II is market discipline. So we need to analyze the market as well. How's the market going, so that we can get a clear picture about the risk associated. And supervisory review to keep a control on the operational activity of business. So if the internal position of banking is not good, how we can go and justify the external position. So first the priority is to look at the internal scenario and try to make it as efficient as possible. Coming to Basel III, so banks under Basel III, it was mentioned that banks are required to maintain minimum of Pillar 1 capital to risk weighted asset ratio of 9% on a continuous basis. So we talked about minimum capital risk weighted asset ratio. So this under Basel III was increased to 9%. As we saw in Basel I and II, it was at 8%, but here it was increased to 9%, looking at the increasing risk involved in this banking business because of the competitiveness increasing and the whole new technology innovation and growing advancement in this particular sector. So along with that, risk was also increasing, and the demand for these banking products was at peak. So it was important to increase the minimum capital adequacy at bank to 9%. And for assessment of capital charge for credit risk, banks have to mandatory obtain credit rating from CRA, that is credit rating agencies approved by RBI. So it was also mentioned that before providing loan to institution or individual, it should be mandatory that you check the individual civil score or you check the institution's credit rating. So to get an idea about the credit behavior of that particular individual or institution, what has been the past behavior, how much defaults they have made on previous loan payments, or was it good. So any good score between 750 to 900 was considered as a as a good score to provide loan, and the bad score gave an indication about that this borrower may default, so it's better not to take so much of risk. And the amount of loan to be given on basis of this was decided. So Basel III norms talked about the increased 9% minimum capital requirement, the credit rating to be checked, and NPA management. NPA management procedures implemented through classification of loan asset at standard, substandard, doubtful, and loss asset. So NPA management came into picture in Basel III norms, and it was mentioned that the loan assets which are being provided, they should be classified on regular basis, whether they fall in standard category, substandard, doubtful, or loss asset. So before it was not being done, it became then necessary that you categorize if the loan on which the borrower is making timely payments and seems to be a good position, so that would be categorized as standard. But if there is being default on 1 to 3 payments for a particular time period, so it should be categorized as substandard. If the tenure of default is increasing, it should be categorized as doubtful and loss assets. So this is how NPA management, so that by categorizing assets we can focus on what particular asset the bank need to focus and how to recover the amount from there. So thank you for watching. This was all about Basel norms. I hope you liked it. Do like and share my videos. Subscribe to my channel, DevTech Finance. Thank you.